Hello and welcome to the download. I'm your host, Dave Richardson, and it is Tuesdays. Once again, not on a Tuesday, but a Tuesday nevertheless. As I think we've established after several years of doing this, Stu, every day is Tuesday.
That's right, Dave. Every day is Tuesday. I say that at home, although I doesn't get quite the same notice from my family members always. But every day is Tuesday.
Really? So you have a wife and kids, and it doesn't seem to work that well, and when you use it at home.
Well, at times, very much in line with Tuesday, but not every day. Every day is not quite Tuesday.
Now, I can tell you, if we were calling it Dave Day, there are 0 days amongst
Yeah.
between my wife, my 2 daughters, and 4 dogs. So I'm at the bottom of the food chain there. But I'm glad it works out for you at least occasionally. And what was Tuesday though is you were Tuesdaying why we're doing it a day late here is you were Tuesdaying around with a lot of your smart friends and colleagues in some of the discussions you have. I guess you have these kind of meetings on about a quarterly basis, just and you get together and just sort of talk to each other about what you think's going on in your area of expertise, and you kind of walk away with a big picture view of what's going on around the world. And it's always a good chance to check in with you and see what's top of your mind from those discussions, because it's always interesting.
Yeah, no, for sure. It's we call it our investment strategy committee. I think inside the firm, there's 20 or so asset classes that are represented in one form or another. So it's a great time to get together and hear what's going on in each class, and where some of the issues that are facing each asset class, how we're thinking about them. Generally speaking, it breaks into kind of stocks versus bonds. And what we tend to do is we start off with the economist, Eric Lascelles, who I know you have on lots of podcasts. But
Yeah.
probably the interesting thing there is that economic activity is pretty reasonable. And I think importantly, when you kind of look out over like a 6 to 12 month period of time, he has some. The one thing I always find interesting is like the odds of a recession
Yes.
in the forecast period, and at this juncture, the odds of recession are quite low. Now, the second thing, which we can get into as we discuss some of the different asset classes, is the biggest risk is if you have a very high valuation and you have, then you're not expecting, you can't afford a recession as well. So there's the interplay between what we think fundamentally and what we think's priced into markets. But we always start with Eric to kind of, give us the lowdown on where economies sit in different parts of the world. Then we roll into fixed income, which is a lot of discussion that flows from the economy about where inflation is headed and where real interest rates are, and not dissimilar to to what we've talked about in the past. The real interest rate is kind of back where it's average. It's at a reasonably attractive rate. So interest rates are in this kind of range, and they've been more volatile, but they've kind of been in a range. And that was actually along those lines. Our technical analyst had some studies on the importance of trend, and if an asset is trending, does it predict the future return potential? And on the equity side, when you have a trending asset, it tends to be a predictor of future returns. But it's not quite the same case in fixed income. They tend to be more mean reverting, more range bound. So this kind of supportive of this idea that interest rates are in this range with a reasonable coupon. And on the kind of headline government bond side, the ongoing belief that, like, should the economy slow, we will get some performance back from our bonds in addition to coupon. So that was all quite consistent. Then we discuss spreads, and we talk about EM bonds, and we talk about high yield investment grade. Spreads are quite low, quite tight relative to history. But again, without without forecasting economic turbulence, likely to remain that way. We did spend some time talking about the hyperscalers, the likes of Amazon and Google and Microsoft and what have you, because they've been issuing a lot of capital. They've been issuing a lot of bonds.
Yeah.
And that has pushed their spreads out a bit wider than they've been. And they've accessed that capital in the United States. They've come to Canada and what they call a maple bond, which is when a non-domestic company issues a bond into the Canadian marketplace. There's those spreads are pretty attractive relative to where they've been, and it was a great.
Stu,
Yeah.
maybe just before we go a whole lot further, the idea of a spread.
Yes.
So why don't you lay out? So we started talking about government bonds, which tends to be kind of your base to determine that spread, and then maybe go from there and just explain the sort of the basics behind the spread, because that'll help connect it to the idea that when you get out to when you move out to higher risk levels in credit, the reason why the spreads are so tight is because if you don't have a whole lot of fear of recession, then you can be pretty comfortable being out there, and it has to do with the spreads relative to government. So why don't you do a little brief explanation of that?
Yeah, no, great point. So if the 10-year bond in the United States is, call it 4.5%, like one way or the other, you're getting your money back from the government.
Yeah.
It might involve down the road them, having to print some more dollars, and that has some implications. But one way or the other, that's kind of the quote unquote the risk-free rate. So then companies have slightly more risk on that top of that. So like if you're Berkshire Hathaway and you're a AAA credit, your lending is quite tight, or your borrowing is quite tight in spread, meaning you don't pay very much more than the US government. And then as you go from AAA to AA to single A to triple B and so forth, the spread or the interest rate above the 10-year bond starts to widen. It starts to increase. The traditional hyperscalers have been very good credits because they've been so cash generative. So their spreads have widened, not so much because people view them as maybe riskier, but there's been a lot of their bonds for sale because they're funding this big capex build out of data centers. And so those spreads have widened, and they could bounce around a little bit while they're issuing more bonds, but look a little bit more attractive. And then that was a segue into the equity people who are covering the same stocks, discussing the capital investment that's going on the data center side that's drawing so much growth in the broader stock market. So, that kind of led into the discussion about how much capex could there be in the next couple of years, and it might be as much as $2 trillion in say 2026 to 2028. How much of that could come from operating cash flow, and how much of that would have to be financed either through equity or through debt. And our rough estimate is probably $400 to $500 billion in the fixed income market. But what we should point out is that these companies do have a lot of cash flow to service debt. So what we're doing is we're saying they can take their debt to cash flow to around 2 times. And there's some nuance to that involving operating leases and things like this. But generally speaking, 2 times debt to EBITDA. If you saw a business at 2 times debt to EBITDA, you'd say that's still right down the fairway of investment grade. So then you get into this notion of how much capital will they have, and do they have enough to pay the interest? And the answer is yes. And then you get into the returns that they're getting on their data centers, where they're hoping for strong growth with north of 30% margins, which will drive good returns there. And then that, you can just see how this discussion just evolves over the days of one thing leading to another. Yeah. We talk about the U.S. consumer, we talk about all sorts of things, but just to finish off on the data center was, what about the models? What about the open source models? Yeah. And how does that impact the hyperscalers? And, there was one chart that showed, if you do a query on something like Claude or OpenAI, per unit that might cost $4. and the hyperscaler gets maybe 80 cents out of that $4. You might do it on an open source model, and it may only cost 85 cents, but the hyperscaler is still getting like 65 cents.
Okay.
So, it's not quite as lucrative, but it's still, quite reasonable. And then the next leg of that discussion is how much growth will there be in token usage, right? And we looked at, this one is, kind of all over the map. It is, there's the ongoing growth of like intelligence replacement. Then there's robotics. Then there's driverless cars. So, on one hand, you could sit there and say the growth could be 100-fold, it could be 25-fold, trying to get, some, ballpark around that. But if you are one of the hyperscalers, even if it's all open source, as long as there's growth, you're still going to make your money. It might turn out differently for the model providers, but for the hyperscalers themselves, they should still get their money. And then then that rolls into, a data center needs, kind of half the money is what they call the shell, the structure, the power. Half the money is for the guts, right? The servers, and one lasts longer than the other. So we get into that discussion. And then, each new rendition of servers generates, about 4 times as many tokens as the old one. So, you have these variables to come into play. So you have very strong potential growth, but then you're going to have new servers, and, so you're working on all these calculations, and we're still at that stage where, the growth prospects are strong, and we are, getting a better and better handle on how the different variables could play out, as we move forward. And that was much of the discussion. We got into some of the memory stocks, and if you recall, we talked about emerging markets, which had been heavily influenced. Those stocks have corrected. So the traditional thesis on emerging markets, which is better consumption, younger demographics, some stronger earnings growth potential, has that reemerged? Now that we've kind of dealt with, some of these memory stocks going down by, 30 or 40, 45%. So there was discussion on all sorts of levels about, positioning the portfolio going forward. But, you're having these discussions around, do I want, fixed income over bonds? How much risk do I want to take? Then within fixed income, you're talking about, do I want high yield? Do I want investment grade? Do I want EM? Do I want duration? On the equity side, do I want the S&P 500, the TSX, Japan, Europe, emerging markets? And, there'll be more to come as these discussions, finish up over the month. But, I think what hopefully you get the flavor for is that there was a pretty fulsome discussion on all these measures, and those are about public markets. That doesn't even really involve private markets, where we've had some activity in this firm recently. But that's probably a separate discussion, and I'm sure you've had some of those portfolio managers on some calls as well.
Yeah, and I think I think the first point I take away, and I have not been in the meetings for quite some time, many years, but I still recall the times when I would attend and just sit in the background. Don't worry, I'm not chipping in with any advice. So they leave all those decisions are for the smart people. But you're right about that discussion. I think it's such an underrated element of the entire process of investment management. The idea of coming up with different ideas, presenting different ideas, and almost like I guess you would call it's a peer-reviewed kind of a system where there's a debate and a challenge around different ideas, but you ultimately come up with a strategy, as you've talked about many times on the podcast. It's not a straight line. Okay, well, we put everything boom right here because we've somebody's won an argument and this is the direction we're going. We're going to have different scenarios, and we're going to place a little bit here, a little bit there, and then we'll continuously evolve as we figure out exactly the way it's going to play out. But that getting a bunch of smart people in a room with a lot of trust and a lot of open discussion leads to better decisions and better results.
Yeah, it's very collegial. Having the comfort to go down all sorts of different rabbit holes.
Yep.
Figure things out, present some commentary that might seem wild, but we should talk through the implications for things. It is a real hallmark, I think. To do that in a very open setting, and of course, you're modest, but your common sense and everything that you see in here is welcome as well. When it comes to these discussions.
Yeah, and you see, that's what I was going to say next. You see, you're sitting at the head of the table of these discussions, and you want the discussion to be open and honest, build that trusting environment again where people can speak up, say what's on your mind. I don't know how many people who listen to the podcast regularly have walked up to me and said, Stu is so nice when you ask him stupid questions. He's always so patient. And so when people are actually raising good points, that
Yeah.
you must be incredibly patient with and listen very closely when people are raising good ideas.
Well, 100%. And while I much prefer the Tuesday moniker, my nickname in university was Stupid. So need to be very open minded.
Okay, well, that's I'll tell you what that means in French
Yeah.
if you haven't figured that out.
Yeah.
But let's go. I think a lot of people are always interested in AI and what's going on there. So the part about the hyperscalers and just that, I just get a sense from what you were saying there. Again, I think of if we talk about what these hyperscalers are getting out of the expansion of AI. I always bring it back to my pie. Got my pie. I'm getting a sliver of the pie, and even if I get a smaller piece, but the pie is gigantic, I'm doing much better. But it kind of seems like there's still a question about just how big that pie is going to be. And again, you're never going to know. We got different scenarios that could play out. Never going to know exactly how big the pie is going to be. But it seems like we're just at a stage right now where there's a lot of questions. Some people think the pie will be the biggest pie in the history of the world, and others think it'll be a really nice sized pie, but not quite as big as maybe some people expect it to be. And that creates the questions around what's going on in AI, and particularly with that build out.
Yeah, I think that is a very good point. I think there is different than some things as they unravel or as they unfold is the price of a token is kind of like that's the cost to do something.
Yeah.
And there might be a significant list of things to do that might be quite dependent on the price of a token, which also makes the demand that much harder to determine, right? If token prices are X and the hyperscalers make money at that X, then you might say, well, demand will be Y. If it's a half X, it's possible that it's more than 2Y.
Yeah.
Because the lower price might then open up more things to do with the tokens, and the hyperscalers would still be good in that situation. So,
yeah.
I think that's where when you think about like driving in a Waymo, when you think about humanoid robotics, when you think about the queries that different models might ask that AGI, the general intelligence, that is the hard thing because like I might turn on a humanoid robot to do some complex task if tokens are X. I may turn it on to clean my house if tokens are Y, or I might do it myself. So, there is a lot to think about in terms of how this will, move forward.
Yeah, we know it's going to be a big thing, but as you say, that whole just how much it permeates the world, and then how quickly is another factor as well. I should mention the Waymos for people who haven't necessarily been in a city with a Waymo. That's a driverless taxi cab. Funny looking car drives up beside you. It's got a thing on the roof. It's an odd shaped vehicle, and you look over and there's no one driving it, but there is someone else in there, just typing away or on a call or doing whatever, maybe listening to this podcast, which you can do if you subscribe to the podcast, wherever you listen to podcasts, or subscribe and watch us on YouTube. Then you could kind of sit in the cab and someone's looking at you while you're watching us. It would be kind of an interesting whole thing there. But the Waymo or the whole the scope of it is just unbelievable where it could end up. And like you say, it likely does end up with the Jetsons where Rosie's cleaning the house in the in the sky.
Yeah, and I think like what we're really thinking about is do I have a funnel where I'm going to collect token usage,
Yeah.
right? If I'm one of the big companies, that's probably a pretty big funnel. If I'm Dave's data center, that funnel may not be quite as big, right?
Yeah.
So then we've got this funnel of demand, and then we've got the data centers, and then there's going to be this significant competition between some of the brand name semiconductors that want to provide tokens, and then some of the companies are getting into designing and developing their own tokens. So you're going to have this funnel of demand, and then you're going to have the cost that you have to provide the token. And the lowest cost token and the biggest funnel is likely going to emerge as the winner in these discussions. And that's just something that we'll be very focused on as the future unfolds.
Yeah, and that's what makes that area of the market so interesting, along with the movements that you see in these stocks, which are quite stunning, and we've talked about that quite a bit on previous episodes. But then again, the other thing that struck me in your initial comments coming out of the discussions was the idea that if they're borrowing money to do this at a high level or issuing stock to do this, there's you got to think of it one way versus where it's been up until now, where they're just generating enough cash flow to pay for this build out, and that's really where interest rates come in and are particularly important. And I think it's been a really unusual fixed income market. I've described it as dull. Dagmara gets very angry at me when I do that. She says it's and bond people think the bond market is very exciting, just like they think a rainy day like it is behind you in Toronto is beautiful weather. They're like that fixed income people, kind of dour. But the idea that it's kind of government plus a little bit, and that's as we move out in terms of spreads, and that's not a particularly exciting market for bond investors.
Well, yeah, like when I started in the business, I used to have an old comment, which was I was clipping coupons.
Yes.
And what that meant was a bond, you used to get the bond certificate in the mail, and then it would have coupons along the bottom, kind of like a something you'd see on a telephone pole, like I lost my dog, call this phone number. So the coupons would be along the bottom of the bond certificate, and you'd cut them off, and that's how you'd get your interest. Um, in an environment where the 10-year is kind of in the United States anyways, call it 4.5. Real interest rates are 2 or 3. Corporate spreads are picking up 1 to 1.5. The income is quite attractive relative to what it's been historically, and then you have some gyration on days that maybe the economy is a little bit too hot, maybe it's a little bit too cold. So you have that range bound component we talked about. But if we have any doubts around the economy, there's room for rates to fall, and that's where you would pick up a little bit more cushion from the bond exposure than you might have historically. But yeah, like it has not been as an exciting place, as the equity market, for a period of time during rising inflation and strong nominal growth. But it still has that role in the portfolio.
And so you leave these discussions ultimately with again an idea of around all the different asset classes and what you might do there, and then is it a case where you go out and you execute those trades immediately? Are you particularly active after that, or this is something where you're you're gonna implement that strategy as it plays out. What's the the discussion to any action that you have? What's the space between those two moments?
Well, this could lead to action, but at the same time, we have an investment policy committee that kind of meets ad hoc all the time. So,
Yeah.
that too could lead to a change. Like we have lots of ways to make changes. I think what this does is, this is a very good day and a half to set the table for the next 3 months and to go back and revisit that and say, how has our thinking evolved over that 3-month period? This could lead to change, but like, in all honesty, like we could meet tomorrow and make a different change. Like changes are very fluid.
Yeah.
This is really like a level setting of thinking from quarter to quarter. We can go back through time. We can feed it to AI. We could say,
Yeah.
like, how did you think about this in the past? We can go revisit notes about, what did it look like in 2015 when this presented itself, these types of things.
Yeah, and that's the one thing about the market and what makes investing so interesting, especially on a professional level, is just how fluid it is, day to day, minute to minute, news flow, shifts things, changes perspectives, changes the way people think about the value of something. Some people think it's going up, some people think it's going down. That makes a market, buy, sell, and away we go. And that's I hope one of the things, and I know, Stu, you obviously not going to share with the entire world precisely every discussion that's happened, but I thought it would be really nice to kind of give a window into the way that a bunch of professionals get together in this business and share ideas and have it come to again, like you say, a level set from which you're going to move forward. You're going to make decisions again on a regular basis, but it's that level set opportunity, and then you move on from there with a good idea about what everyone's thinking about everything that's going on in the world and how it might affect your particular asset class or the money that you're managing.
That's right.
Wow, I actually got that right. I was worried. I've been on a dumb question run on this episode of the podcast today, Stu. I think we need to get back to Stu's days. I'm sharper on the actual Stu's day.
Yeah, that's right.
Yeah, you seem skeptical, so maybe not. Maybe this is just the if Stu's day is every day, maybe I'm not that sharp on any Stu's day. Anyway, Stu, thanks a lot. I know how busy you are, and really appreciate you taking the time this afternoon to get together and say hi to everybody. And we'll talk to you next week.
Great, thanks, Dave.
This podcast has been provided by RBC Global Asset Management, Inc., RBC GAM, and is for informational purposes as of the date noted only. It is not intended to provide legal, accounting, tax, investment, financial, or other advice, and such information should not be relied upon for providing such advice. RBC GAM takes reasonable steps to provide up-to-date, accurate, and reliable information, and believes the information to be so when provided. You should consult with your advisor before taking any action based upon the information contained in this material. All opinions constitute our judgment and are subject to change without notice. The information presented here is provided in good faith without legal responsibility. RBC GAM reserves the right at any time and without notice to change, amend, or cease publication of the information.